Have you noticed no matter how much money you save in the bank, things keep getting more expensive? Every year, your $100 seems to buy less and less things. Do you worry about the future and how you will afford things? In this video, I will show you how your money in the bank slowly vanishes year by year, then show you how James overcame this problem and did what the rich do to get ahead. Watch to the end to really understand why most people will work very hard and save every penny but still end up poor. This is Growth Guide, your simple guide to growing your wealth. Let's be clear, I'm not saying not to use banks full stop, but you need to know the secrets of indexing to understand why money in the bank will gradually make you poor. Most people don't know what indexing even is and why it will slowly chip away at what you have sitting in the bank. To explain indexing, we need to look at inflation and the interest earned by keeping your money in the bank. In your lifetime, you have surely experienced inflation. It's when the price of goods and services increase due to economic conditions. I'm sure you could testify that $100 5 years ago would fill your shopping trolley a lot more than what it does today. The more appropriate way to look at this is not that things are becoming more expensive, it is that the money that we are buying things with is worth less over time. Now, why would that happen? Well, it's because during certain economic conditions, the central bank, who manages money and credit in the country, decides to print more money. So how does that affect inflation? To illustrate, imagine you and I were farmers. You had one pig and I had one cow. We decide to trade, so one pig for one cow sounds fair. Now, my cows could only give birth to one calf at a time, but your pig could have a litter of 10. After one breeding season, you have 11 pigs and I will have 2 cows. My cows are now more scarce than your pigs. Our previous one cow for one pig system now becomes unfair for me. You best believe I will ask for more than one pig the next time we trade. The same thing happens when the central bank approves to print more money. More dollars floating around means that the buying power of the dollar drops. That's why you may only fill a shopping basket now for your $100 grocery shop. So that's inflation. What about bank interest? Banks work off a system called fractional reserve banking. What this means is that the bank is allowed to loan out the money it stores for their members. A certain percentage of the money they store can be loaned out to people to earn interest on those loans. To incentivize you to keep your money with the bank, they offer you a bank interest that you earn to store your money with them. If one day everyone decides to pull all their money out, the bank is in real hot water because they really don't have all the money. A percentage has been loaned out for them to earn an interest. So what is indexing and how does inflation and bank interest slowly but surely steal your money? Indexing is the term used for the tracking and adjustment of financial parameters over time. So let's look at the indexing of inflation versus the interest banks offer you to keep your money. You'll see why you're getting robbed in broad daylight. The banks never pay you enough interest to overcome the indexing of inflation. So typically inflation, let's say, is 3% every year, meaning that what you can buy with $100 today will cost you $103 next year. Remember, because more money being printed equals less buying power. Now, banks are never that generous and typically offer a lower percentage than what inflation is indexed at. So if inflation is 3%, the bank will probably offer you 1% interest to keep your money with them. So your $100 in the bank next year will be $101. But the same things next year will cost you $103. Therefore, you lost a net of 2%, which is $2 over the year by keeping your money in the bank. Doesn't sound like a big deal, does it? But let's scale that to the potential thousands in your savings. $50,000 in the bank at 1% interest after a year will become $50,500. But at 3% inflation, you would need $51,500 to buy the same amount of goods. The net loss of 2% now means you lost $1,000 from saving your money in the bank. So, are you really getting ahead or stuck on the hamster wheel? Keeping your money in a safe at home is even worse. You won't even be able to earn interest to offset the indexing of inflation. Then you'll lose the whole 3% from inflation. That's $1,500 because you didn't receive the bank interest. So, what do? Find assets to put your money into that index greater than inflation. This is called hedging. You are hedging your money into something else to minimize the loss due to inflation. You can't change how the world works. The best thing to do is learn the rules and play the game. So let's say you park your savings of $50,000 in an index fund like the S&P 500. The S&P 500 averaged a 7.51% annual return over the last 5 years. So if inflation is indexed at 3%, your 1% interest with the bank will equal a net loss of 2%. But money sitting in the S&P 500 index fund will equal a net gain of 4.51%. That is 6.51% total net difference. Now, James and his friend George test this out. James and George have worked together for 9 years now. They decided to treat themselves on their 10-year anniversary and buy the same car. The car they both have their eyes on is worth $50,000. James and George have the money today but want to make it special and buy it on their 10-year anniversary. George leaves his $50,000 in savings in the bank and is pleased that the bank offers an attractive 1% interest yearly. James, however, who understands indexing and inflation, decides to hedge his money in the S&P 500 index, which typically performs at 7.51% per year. After a year passes, inflation was indexed at 3%, and now the car James and George had their eyes on is now valued at $51,500. George checks his bank account and sees that he has $50,500, whereas James's money in the S&P 500 grew to $53,755. James and George buy their cars, but who got the better deal? George used his $50,500 from his savings and a further $1,000 on top to buy the car, whereas James walked out of the dealership with the car and an extra $2,255 in his hand. George's strategy left him $3,255 worse off than James. That's why leaving your money in the bank will slowly but surely make you poor. Imagine you did this over a lifetime. This is the actual reason why the rich get richer and the poor get poorer. Where you choose to store your wealth matters. To summarize, inflation diminishes the buying power of money over time. The banks never pay you enough interest to offset the indexing of inflation. Hedge your money in assets which performs better than inflation. Hit the subscribe button and view the next video and get more simple guides to grow your wealth.